The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Welcome to Nova 401k Associates webinar on Introduction to 401k Plans for Plan Sponsors. Today's webinar is eligible for CPA credit. Right after the webinar ends, you will see the survey pop up if you are needing CPA credit. We have also added the slides as a handout. Just click the handout drop-down on your GoToWebinar panel, and you can download and save the file to your local folder. Today's presentation will be presented by Senior Account Managers Sue Harper and Charlene DeMartini. If you have any questions, please type them in the questions box and we will go over them at the end. I will now hand it over to Charlene.
Hi, everyone. Thanks for joining us. Sorry about being late. We had a couple of technical difficulties. We're still trying to figure them out. So for now, I will be the presenter today, and hopefully Sue can add on. But again, thank you for joining us. We're going to talk about Introduction to 401k Plans for Plan Sponsors. There's a lot of information in this presentation, so please type in any questions in the questions box and we'll try and get them at the end. Just a little disclaimer here that the information in this presentation is general in nature, not intended to be a substitute for legal or tax advice, and to please consult a qualified professional such as an attorney or accountant if you need legal or tax advice. As Jasmine mentioned, we do offer CPA credit. Our provider number is 009-820. You must be registered individually and be present for the entire seminar. You'll have a completed evaluation at the end to complete, and then your certification will be sent within 1 week through email. We have several things on the agenda today. The first is we're going to go through roles and responsibility of who is involved in a 401k plan. We're going to go through NOVA cybersecurity measures, 401k basics, some moving pieces in the plan, distribution and loan basics, and then we'll go through an annual calendar of what you can expect throughout the year. So as we get started, we'll just talk about the roles and responsibilities for a 401k plan. There are typically four entities that are involved in the retirement plan. The first would be you as the plan sponsor. Then would be the financial advisor, NOVA as the TPA, and then your investment provider. And these all prepare different items for the plan. You as the plan sponsor would have overall fiduciary responsibility for the plan, communicate the plan to your participants, remit the plan contributions, and then you provide the data to NOVA annually to complete the discrimination testing and government returns. And we'll go through what that all means as we go through these slides. Next, the financial advisor. That's who will take care of your enrollment meetings with participants and provide education and assistance on how to select the investments for your plan. They'll also make sure that you are compliant with 404C compliance, which means that the fees and those involved in the plan are prudent. Next, as NOVA, as the TPA, just a brief list of what we do. Prepare and maintain the plan document, which is the legal document for the plan that houses the plan provisions. And we'll go through a little bit of that during the presentation as well. We complete the required annual testing, prepare the annual government filings, and we provide ongoing consulting for the plan as you go through the year. And then lastly, the investment provider is where the money is actually held. So they are the custodian of the plan assets. They'll provide statements to your participants on a quarterly basis. They will take care of the distribution withholdings and reportings, and they will invest the contributions that you're submitting into the market and provide daily record keeping. So again, this is just a brief listing of who all is involved in the plan. For you to keep at your fingertips in case you need to know who to call. But if you ever have any questions, just contact your account manager here at NOVA and we can get you in contact with who you need to be in contact with. First, we want to go through NOVA's cybersecurity measures. And this is important because there's a lot of confidential data that we are handling for your plan, whether it be the Social Security numbers for participants, date of birth, processing distributions and loans. All of that information we want to make sure is secure for you and your participants. And since 401k plans have a lot of money in them, there are a lot of bad guys out there who have noted this and unfortunately have conducted fraudulent activities against some retirement plans. So we have a lot of things on hand that we do to prevent your information from getting out there. But these coordinated attacks can be on the record keepers, from a phishing attack and hacking an employee's email so that they're able to change your passwords. And with those new passwords, they're able to access private information and request loans and distributions. With the ACH and wires, typically there's trivial amounts recovered when the theft is discovered. Unfortunately, that money, once it's wired or ACH debited, that money is gone, hopefully not forever, but seemingly forever. And you would think that this type of theft will be covered by your insurance. Unfortunately, the 3 insurances that we've listed here, this part of theft is not covered under any of these different insurances and bonds. So we all need to be alert and try to prevent this in the best way possible. And as I said, we'll go through some ways that Nova is helping to keep your information private. Again, this is listing all the different items that we might communicate with you that should be confidential: census files, deferral files, payroll files, address files. The testing will include some of this data. Annual valuation reports include information on participants' account balances, tax forms. This should never be sent via email without encryption. Please encrypt the file and send it over to us. But even more, a better idea, I should say, is to send this via the Nova web portal. And we'll go over that in a couple of minutes. But the Nova web portal will allow you to send a file securely. And on our end, we would need to log in and pull that data. So please do not send any of this private information through email. So here's our secure web portal. If you haven't already been on the link, please go ahead and visit our website. But this will offer you an area to send a secure file transfer. You just select your file, select the person you're sending it to, and then we will receive an email, that person that you're sending it to, that there's a file out there, and we'll have to log into our side of things and pull that information down. So it's a very user-friendly system, and if you have any questions on using that, just call your account manager so that we can make sure you have the correct access and can send those files. In addition, we have encryption software. So if we do send you something through email, it will be encrypted, but more than likely we're going to be sending it through the plan sponsor link instead of email. If you were accessing the plan and someone contacts us to add them as a plan contact, we will be reaching out to an existing contact or even the trustee for the plan to get permission to add that person. We don't want to just willy-nilly add someone onto your plan that can access that information. So we are going to confirm that we have permission to add that. Also at Nova, we have mandatory training for all of our employees every quarter. So each quarter we'll have some kind of webcast and test on what we've learned during that webcast that goes through all the different fraud availability, I guess, if you will, how the different ways that someone can create a fraudulent activity. And then in addition, for every single website that we visit, every record keeper, we are changing our passwords every 90 days. And we sign off on a certification that we individually have changed our passwords and submit that to our HR department. So we take this very seriously with your confidential data. So if you have any questions on that, just let us know. So again, just use the census upload function. to submit your annual data or any confidential emails you want to send us. And then, of course, limit the number of people that are copied on an email so that it reduces the number of people that can be hacked to gather that information. Then, of course, use complex passwords. We all know that this is like, not easy when you're trying to type in a password when you have all different characters, uppercase, lowercase, but really that's the only way that we're going to be able to protect our information. So now, having said that, yes.
I'm sorry to interrupt you. This is Sue Harper. I've made it through my technical difficulties. If you'd like me to jump in.
Sure. Okay, everybody, I'm going to have Sue take over, and then I will join you guys later in the presentation. So, Sue, if you just want to turn it over to me after slide 39, we'll go through.
Sounds great. Thank you. And thanks for picking up.
Sure.
Well, let's see. I apologize. Apparently, I'm still having technical difficulties. Not my day.
No problem. Do you have the slides there?
I did, and then they went away.
That's okay. Do you want me to have Charlene show the slides for you?
Charlene, if you wouldn't mind, I would really appreciate it.
No worries.
Okay.
So hopefully everybody can see my screen now that Jasmine's updated, and we should be on the 401k basics.
Yes, ma'am.
Okay.
All right. Well, thank you both so much. As Charlene said, I'm Sue Harper. I'm one of the senior account managers here at Nova also, and I'll just kind of continue on with the presentation. We're going to, as Charlene has said, we're going to talk about 401k basics and some of the things that go along with the 401k plan. So first of all, just a little bit about a 401k plan. They give employees an opportunity to save for retirement on a tax-preferred basis. Payroll deduction is the best way to save. Most people, honestly, if they don't do it through payroll deduction, it is very hard for them to save, especially for retirement at all. So a 401k plan through their employer, it gets taken out of their check. They don't even, most of the time, maybe even realize it. And then at least when they retire, they do have that bucket of money for them. For most people, the 401k, it's the biggest asset outside of their home because it's their best way to save. And if they've been working for 40 years and saving for 40 years, they have hopefully a good amount of money to help them live the kind of life they would like to during their retirement. 401k plans have become primary retirement plans for most people. In the past, years ago, a lot of companies offered what were called pension plans. And with those, the employer was responsible for funding the retirement plan. The employees did not put any money in at all. The employer took care of that for them. It's a great benefit, but it's really not economically feasible for a lot of employers right now. So 401k plan is a great option. It gives employees the chance to put money in, and then the employer can as well. So the 401k plan is really a valuable employee benefit. All right, next slide, Charlene. 401k plans are very heavily regulated by both the Internal Revenue Service and the Department of Labor. And they both have regulations that kind of apply to different things. With retirement plans, IRS is more concerned about the tax status and the money that's sitting in that account that nobody's paid taxes on yet. When the money goes in, most of the time, unless you're contributing with Roth dollars, most of the time the money that's in a 401k plan is pre-tax. So it goes in without any taxes, and it's not taxed until the employee takes it out. That can be years and years. So the IRS is concerned and watches that. So the Department of Labor is more concerned about is the plan fair and are contributions going in when they're supposed to, things like that. We'll go into that a little bit more. With 401k plans, common sense doesn't always help, and we'll go through a little example in a few slides to kind of show that. With 401k plans, rules frequently change. There's changes that happen all the time. This past year, there were changes because of with the CARES Act and Secure Act. When different things happen in the world and with the economy, 401k plans can be impacted. NOVA will always let you know if there's any change that has come up that's going to impact the plan. But in almost all cases, your written plan document controls. All plans are given, or all plans have a retirement plan document and adoption agreement where they make elections on how they want their plan to operate. That's kind of the Bible of the plan sponsor's 401k plan. So next slide, please, Charlene. All right, as I said, the IRS is concerned kind of with the tax status and the tax of the retirement plan. So 401k has to obviously stay in compliance with federal statute and IRS regulations. IRS also is concerned with non-discrimination testing, making sure that the money is put into the plan in a non-discriminatory way. IRS looks at taxable events and deduction limits. As I said before, when somebody puts money into the plan, most of the time it's pre-tax and it sits there. But when they take it out, it's a taxable event. IRS wants to make sure that the proper taxes are paid on those dollars when that is taken out. IRS also looks at deduction limits. There is a limit as to how much an employer can put into the plan, and part of the compliance testing we do actually looks at that as well, but the IRS would check to make sure plans don't go over that deduction limit. IRS makes sure that the plan document is amended timely, so it makes sure that the plan document is compliance with all of the rules and regulations that it needs to be, and that it is updated as it should be. Every 6 to 8 years, a retirement plan has to go through what's called a restatement, and it's updated for any new legislation that's happened since the last document restatement. Any amendments that come out get combined into this new plan document. Actually, right now we are in the middle of a restatement, so if you haven't already, you will be potentially getting a new plan document. If you're new to NOVA, it's a good chance you already have that document, but it is something that we are working on. And then also IRS makes sure that all the terms of the plan are being followed. The Department of Labor, on the other hand, looks at 401k contributions and loan payments, that they're being deposited when they are supposed to. That the lineup, the funds that are available to the employees are prudent. Don't want to have all very conservative funds if most of your workforce is in their 20s. You want something where employees have a chance to grow their money. Department of Labor looks to make sure that any expenses that are paid by the plan are reasonable. And they can review the Form 5500 that is submitted to them each year. That kind of gives the plan information and a summary of all the assets in the plan. They review that to make sure that some of these other things are in compliance. So, all right, next slide. One of the options in a retirement plan is eligibility. And this is just kind of an example of something that could happen in a plan. Say a plan sponsor wants to exclude hourly employees from his 401k plan. First of all, the plan document must be written to say that hourly employees are excluded. If it's not in the plan document, then you cannot exclude those employees. The plan must also be able to pass IRS coverage testing. Coverage testing is one of the compliance tests that we have to do every year to make sure that a fair number of employees are benefiting from the plan. We can't have a plan where only the owners are benefiting and none of the other employees are able to contribute. It has to be a fair mix for both, or for all groups, all eligible employees. All right. This is one where maybe common sense does not prevail. What is a preferred investment alternative for an employee who puts money into a 401k plan but fails to make investment selections? An employee might elect that they want to contribute 10% to the retirement plan. They might turn in a payroll deduction form if that's the way it is done for this employer. So maybe they don't make an investment election at all. Well, when that money is withheld from pay, the record keeper wouldn't know what to do with it. So there should be, all plans should have an investment alternative. And in the past, money market and stable value funds were usually used for this purpose, but those funds don't really offer a whole lot of growth. And if maybe, again, a 20-year-old makes an investment or makes a contribution election but doesn't pick an investment, their money wouldn't really ever grow and they wouldn't have any opportunity to get any gains on that money. So the Department of Labor stepped in and said, you know, instead of having money market or stable value funds, it really should be a balanced fund or a life cycle fund. Life cycle fund would be like your target date fund. So if somebody is 30, they would go into an investment that's more aggressive than somebody who is 60. It kind of depends on their age as to what funds they would be invested in. Most plans have that as an option in the plan, and that would also be a default if it would be a default if somebody does not make an investment election. All right. The other thing that is really watched is timely deposits of 401k contributions and loan repayments. When we look at retirement plans, we kind of have two types of plans. We have a small plan and a large plan. Small plans are those types of plans that have under 100 eligible participants. And the Department of Labor says that that size plan should be able to get contributions that are withheld from pay deposited within 7 business days after they are withheld. Now, that's what they call a safe harbor. That would be the longest that it should take. Really, even in an audit, they're going to want to see those contributions deposited as soon as possible when they're withheld from pay. Day they're withheld from pay, maybe the day after if needed. 7th business day would be the absolute longest, but in the event of an audit, there would probably be questions if somebody withheld or somebody waited 7 days to deposit those contributions. All right. So the other type of plan, a large plan, which is more than 100 participants, they actually say 15 business days, the 15th business day is the month following when they are withheld from pay. Really, again, they say that is when they have to be deposited by, but really they should be deposited as soon as possible. Again, the day that they're withheld from pay or within a couple of days after that. This is a huge issue in Department of Labor audits, and it's also a huge issue for plans subject to a CPA audit. The Department of Labor is going to look, why couldn't you deposit that till the 15th business day of the month following? And maybe there should be an improvement in processes to make sure that that money goes in sooner. It's also a huge issue for plans subject to a CPA audit. When a plan is a large plan, over 100 people, besides NOVA doing its normal annual compliance work, the plan has to receive what's called a CPA, an independent audit. CPA audit will look at plan procedures, investments, make sure that the plan is following all the rules when it comes to investment options, and CPA audits will check when contributions go in. They just kind of re-review the whole plan and put together an audit report, make sure it's meeting everything that it is supposed to. All right. When, as part of a kind of a plan summary or plan reporting that a retirement plan is required to do every year, plans are required to file a Form 5500. Again, annual report for the plan. For a small plan, you would file a Form 5500 SF, which is a little bit less information than a large plan, which files a Form 5500. But again, it's annual report for the plan. It includes participant accounts, fees paid, kind of an income statement, and a financial statement for the plan. The Form 5500 and 5500 SF are required to be filed electronically. That is a form that NOVA will prepare, and then we will send an invitation to be filed electronically. we can help you through that process, help you file it, make sure you can get logged in. And we also follow up to make sure that the form was actually filed and signed and accepted by the Department of Labor. All right, next one. The Form 5500 must report the amount of the plan's Fidelity Bond. All plans are required to have a Fidelity Bond of 10% of plan assets. So when we look at the end of the year assets in a plan, they must have a Fidelity Bond that covers that amount. That Fidelity Bond covers if there's a theft, not a theft by like an outside party, but maybe an internal theft, something like that. It's kind of an insurance bond on the retirement plan. The Form 5500, when it's submitted, must also attach a copy of an audit report that was prepared by an independent CPA if they are over 100 people. So if the plan is what's called a large plan, they would need that independent CPA audit. That report must also be attached. Okay. Another part of a 401k plan can be payroll integration. And this payroll provider would submit full census data each pay period to the investment provider. That would include addresses, dates of birth, dates of hire, compensation, contribution amounts, all of that type of information. Most investment providers will have a file format. Payroll provider can import that information, and then that way that investment provider has all of that. Should also include all employees, regardless of whether or not they contribute or defer to the plan. All right. Why would a plan want to use payroll integration? It can make it easier for the plan. Actually, census information. Each year, NOVA requests census information. And if a plan uses payroll integration, that census information might be able to be pulled right from the record keeper rather than NOVA having to ask the plan sponsor for that information. Another reason it might be good to use payroll integration is automatic distributions to participants. Part of that payroll integration information would include a termination date, and with some investment providers, they would send out distribution paperwork to a participant if they receive a termination date. Most plan documents will say that if an account is under $5,000, the participant will be forced out if no response after 30 to 45 days. So they can send out a distribution packet. If no response is received back, they can force out that account. So it doesn't just sit there and plan doesn't end up with a lot of account balances under $5,000 for participants that have left. The vendor can also track enrollment. Once the employee data is in the system, the vendor can send enrollment packet to the participant when they are eligible. That really can help out a plan sponsor, so that plan sponsor doesn't have to track maybe so closely the entry dates for participants. The vendor can help out with that. And then census information can be updated at that vendor as well. Address changes, dates of hire, maybe payroll contribution amounts. Those amounts can be shared and updated in one system, and the plan sponsor would not have to be responsible for transmitting that information everywhere. All right. There are a couple of types of payroll integration. Payroll 360, kind of like it sounds, data flows both ways. Census data is provided to the record keeper, and then payroll changes and loan requests, things like that, are transferred back to the payroll provider, plan sponsor, if some of those things occur. It's just kind of a round circle, and it can be very helpful. It's a little easier maybe for employees. They can go on to that record keeper site, make their changes, and then that record keeper can relay that information back to the payroll provider and plan sponsor. There is also payroll 180. Census information only flows one way, so it's provided to the record keeper from a payroll vendor, but that record keeper does not supply information back to the payroll vendor. So there's two different ways to do it. depending on your payroll provider and depending on the record keeper, would depend on which option is available. So it might be something that would work for the plan. It can just help alleviate a little bit of work from the plan sponsor. All right. Next one. All plans every year are required to go through compliance testing. Each year, NOVA would request census information from the plan sponsor or potentially the record keeper or payroll provider. And we use that information, that census information, to complete compliance testing. One of the tests that's done is the ADP test, actual deferral percentage test is what it is. And it's a test that looks at the amount of deferrals that highly compensated employee makes compared to the amount that the non-highly compensated employees make. If highly compensated employees are contributing 50% of their pay, where non-highlies are only contributing 10% of their pay, it can be a discrimination issue, and there might be taxable refunds due to highly compensated employees. All right. So who is a highly compensated employee for 2021? Any employee in the testing year who earned more than $130,000 in the prior year, so anybody who earned $130,000 or more in 2020, a greater than 5% owner, so not just 5%, but 5.01%. Somebody owns that, even if they make $20,000 a year, they are still considered a highly compensated employee. Or a lineal family member or spouse of a direct 5% owner working at the company. So if Jane Doe owns 50% of ABC company and her husband Jack works there, Jack would be a highly compensated employee as well, because he would be considered to own the amount that Jane owns, so therefore he would also be highly compensated. All right. But besides highly compensated, can you go? Okay. Another type of non-discrimination testing that we do is what's called top-heavy testing. Top-heavy looks at the balance for key employees, and if those key employee balances are more than 60% of the total account balances, the plan is what's called top-heavy. Top-heavy plans are required to make contributions for non-key employees. So we'll look at, every year we have to look at what the total account balance is of the plan, and then look at what the key employees' balance is and determine if the plan is top heavy. All right, so what is a key employee then? Key employee is someone who is greater than a 5% owner, so kind of like a highly compensated employee, but in this case, they would also be a key employee. Key employee could also be a 1% owner with compensation greater than $150,000, an officer, compensation greater than $185,000, or a lineal family member or spouse of a direct 5% owner working at the company. So potentially you could be a highly compensated employee, but not a key employee. But key employee is what we need to look at when we do that top-heavy test. So each year we would determine who are highly and who are key employees. So there is another type of a 401k plan that helps with that actual deferral percentage test and also top-heavy test. And they are called safe harbor plans. Safe harbor plans are exempt from those tests. If a plan is a safe harbor plan, they don't have to worry about how much assets is in the key employees plan or how much the highly compensated employees are contributing. If it's a safe harbor plan, it would pass. So we'll talk a little bit about safe harbor plans. There's two different types of safe harbor plans. One is safe harbor matching. And with a safe harbor plan, basically the employer or the plan sponsor commits to giving employees a contribution each year. And in exchange for doing that contribution, they are exempt from the ADP test and that top-heavy test. So if they agree to be a safe harbor match contribution, there's a few different matching formulas. One of them is a basic match formula. 100% of the first 3% an employee contributes, 50% of the next 2. So basically, if an employee contributes 5%, the plan would put in a 4% matching contribution for that employee. A matching contribution that Safe Harbor could also be maybe 100% of 5% that an employee contributes. There's a few different options. Definitely something, if anybody's interested in, we can look at the plan document, and that is a change that can be made in the plan document. Another type of Safe Harbor plan is what's called a Safe Harbor non-elective. So instead of doing a match that an employee has to contribute in order to get, all eligible employees would receive a 3% contribution of pay, regardless on whether or not they contribute. So again, this would go to all employees, even if they don't contribute, and it would be 3% of their pay. It will go to all eligible employees employed during the year. And these contributions are always 100% vested. So they're great because it allows an exemption on some of the testing, but the employer does have to make a guaranteed contribution in order to get that exemption. All right. Some of the other tests that we do for retirement plans is coverage testing. I've talked a little bit about this before. Coverage testing is where the non-highly compensated employees can't all be excluded and only cover owners. We have to make sure that all groups of employees are represented in the plan. Profit sharing testing. This is a test we might have to do when a company or when a plan sponsor wants to do profit sharing. There's a lot of different formulas that can be used and a lot of different ways that it can be done. Certain types of profit sharing, we do have to check and make sure, again, it's not discriminatory towards anybody. We have to make sure that not one person isn't getting all of the profit sharing. It has to be split out among all the eligible participants in a non-discriminatory way. So we do have to check for that. Also have to check for compensation testing in some cases. Some plan documents are written so that maybe bonuses are excluded or commissions are excluded. Well, if you have a group of salespeople who are only paid on commission and you exclude commissions from the plan, that's not really fair to those people. It could be considered discriminatory. So it's a test that we would have to review if there's certain types of excluded compensation in the plan every year. All right. Before we mention that there can be amendments done to plans, and we want to make sure that plan documents are amended timely. Plan documents have to be amended from time to time to stay current with new legislation and IRS regulations. Amendments need to be executed timely, and penalties could apply for failure to execute a timely amendment. Now, if it's an amendment that a plan sponsor is requesting, NOVA will help with that and kind of follow through and make sure that amendment is done. And if it's an amendment that's being done due to new legislation, NOVA also watches out for that, will inform any plan sponsors that this is the amendment we have to do and the reason why. And then we will also follow up to make sure it's signed and taken care of. It's plan sponsor is the one who's ultimately responsible for getting it signed, but we will do everything we can to help make sure that it gets taken care of timely and we can avoid any type of penalty or any issues at all with that. All right. Some of the things that are covered in the plan document are eligibility. When is somebody eligible for the plan? And we'll go into that a little bit more in a future slide. Entry dates. So maybe they've met eligibility requirements, but when did they actually enter? Compensation is defined in the plan. What compensation is used for plan purposes. If the plan sponsor is going to do an employer contribution, that is documented in the plan as well. It may say a discretionary contribution is done, or it may say a match of 50% of the first 6% is contributed. So that information like that is in the plan document. The vesting schedule as well is listed in the plan document. When the employer makes a contribution to the plan, something other than a safe harbor contribution, so a regular match or a regular profit sharing contribution, those contributions are subject to a vesting schedule. It's the ownership that an employee has of that money, and it's based on the amount of time that they've been there. Each year an employee is there, if money is subject to vesting, they gain ownership in those contributions. So, all right, next one. Because there are always changes and there's so many moving pieces to a retirement plan, unfortunately there can be errors when handling a retirement plan. Some of the common errors that we see are excluding bonuses from deferral elections. Maybe the plan document doesn't exclude them, but bonuses, the employer doesn't realize that they need to include them and just doesn't give people the chance to defer from bonuses. Excluding part-time employees from the plan, that is a big one. They think maybe, oh, because they're not eligible for other benefits, they aren't eligible for the retirement plan too. But unless there's a specific exclusion for a type of employee, they would have to be covered by the plan. Matching catch-up separate from non-catch-up contributions. Matching Roth contributions separately from pre-tax contributions. Within a retirement plan, there is a limit on the amount of money that an employee can contribute from their pay, and it can contribute as long as the plan allows it, Roth contributions, so after-tax dollars or pre-tax dollars. When there is a match, it looks at those two contributions together. So if money is being contributed 3% Roth and 3% pre-tax, if the plan sponsor matches 100% of the first 3%, that employee would only get a 3% match. Doesn't matter that they're really contributing 6% overall. Another common error is not distributing the summary plan description. Summary plan description is a part of the plan document that kind of lists all of it's a basic background for the employee of the adoption agreement, the plan document. It's the way that the employee can look and see what's offered in their plan. So the employer has to make sure that they distribute that information to them. Not allowing new employees to participate pursuant to the plan. Unfortunately, this does happen too. Maybe a plan doesn't typically hire new people, but they do. When that person meets eligibility, plan sponsor has to make sure that they allow them the chance to participate in the plan and not forget that they're eligible. Not capping match contributions based on the annual compensation cap, and we do have an example of this coming up. So, all right, next one. So here's an example of not allowing participants to enroll on time. ABC Company's plan has no age or service requirement, but doesn't offer Steve enrollment into their plan for 6 months. So he should have been enrolled on the first day, but whatever happened, and he was not allowed. ABC Company will have to make Steve whole by making an employer contribution for the missed deferrals and also that employer match. So the employer plan sponsor would have to put money in Steve's account because he wasn't given that opportunity to contribute. All right. Not properly capping, the matching contribution. Within a retirement plan, there are some different limits. And for 2021, compensation limit is $290,000. So it doesn't matter if somebody makes $800,000. For plan purposes, compensation is going to be $290,000. So if an employer contributes 50% of the first 6% that an employee chooses to contribute, the maximum match amount any one participant can receive is $8,700. Even if, like I said before, even if they make more than $290,000, that is the largest match that they would receive. A lot of times, plan sponsors don't put a cap on that compensation and just keep on matching up until the year ends. So, all right, next one. Okay, initial eligibility. Plan can have different types of eligibility, and for quite a while, and it's still pretty common right now, maximum waiting period for eligibility is 1 year, age 21, with a minimum of 2 entry dates. So typically, an employee would have to work, they'd have to be age 21, work at least 1 year, and then they could enter the plan either January 1st or July 1st. That's about as strict as a plan can have. Certain number of hours might be required in order to accrue that 1 year service. So it might not be that they've just been employed for that amount of time. They have to have worked 1,000 hours during that time. Age requirement can never be over age 21. Shorter waiting periods are definitely okay. Some plans do, you're eligible the date you're hired, or maybe eligible after 3 months of service. Those are all great eligibility requirements and perfectly fine. The strictest you can be, though, is that 1 year, age 21. So when looking at eligibility, initial computation period is 12-month anniversary from the date of hire, and then typically changes to the plan year. All right, so we'll kind of go through just an example of when somebody would enter. So if the plan does have a 1 year of service for semi-annual entry date, employee is hired on June 1st, 2019. Between June 1st, 2019 and June 1st, 2020, they work 1,000 hours and they're age 21. They would enter the plan on July 1st. If, say, they worked 800 hours between June 1st, 2019 and June 1st, 2020, we would then look at the next eligibility computation period would be January 1st of 2020 to December 31st, 2020. If they work 1,000 hours during that time, that person would be eligible for the plan January 1st, 2021. So, all right. Rehires. So from time to time, an employee will leave for whatever reason, and then maybe they decide to come back or they're rehired back for some reason. If that former employee was eligible when they left, and if they ever had a single vested dollar in the plan, they never lose their prior service credit. So even say they worked 10 years ago, they had made one contribution at that time of $5, and then they get rehired 10 years later, they're still eligible for that plan on their date of hire. They didn't have any vested dollars in the plan, they would lose their prior service credit after 5 consecutive 1 year breaks of service. So in my example, if they've been gone for 10 years, but say they never had any vested money in the plan, they're treated as a new employee. Rehires who haven't lost prior credits are eligible to participate immediate on that date of rehire. All right, next one. Okay, and this is kind of where Charlene's going to take back over.
Thanks, Sue. I'm back, everyone. For anybody that used to watch Seinfeld, I just had a vision of me sliding into Jerry's apartment like Kramer did, but I didn't really do that. Any case, so we've covered a lot of information, and so now we're going to get into some moving pieces in the plan. You know, we covered the census data and the testing that we complete each year, the 5,500 that we complete each year. And as we loop back around, just to remind you again of the entities involved in the plan, the record keeper, the TPA, the investment advisor. All of these entities are there to help you with all of this. Obviously, we don't expect you guys to be specialists in all this data. So we do ask that you just contact us with any questions that you have, and we'll point you in the right direction. And I don't know if you guys can see all these pop-ups, but I'm trying to delete them as fast as I can because I don't know why they're coming up. In any case, so with saying that, with the hey Sue, can you confirm if you can see all these pop-ups, because I can't get them to go away?
Yes, I can.
I have my tel closed, so I'm not sure why they're popping up, but I don't know. The show must go on. In any case, again, just a brief reminder of who does what. The record keeper, just remember that they keep the money for the plan and provide statements TPA, we're going to complete the testing, consulting, plan documents. Make sure you have the best design that's available for your plan. As Sue mentioned, the safe harbor plans could help with, or safe harbor design rather, could help with some of those testing issues if you have testing issues. And then, of course, the investment advisor, keeping the client relationship and making those enrollment opportunities to participants, and completing an annual review, making sure that everything is prudent for your plan. So as we look at this schedule, we're going to go through some moving pieces in the plan of how things occur. So most important to participants, how does our money get to the record keeper? Well, as Sue mentioned, they're going to have a payroll deduction for whatever deferral they would like to make. And most record keepers will provide a secure website for you to upload that information. So typically it's a spreadsheet that you can upload with the Social Security number, pertinent information, including deferrals. And if you have the Payroll 360 integration, as Sue mentioned, it would probably include all of those addresses so that they can track address changes, termination dates, all of those information. But whatever information you're providing, that information is either from your payroll company or you as the plan sponsor are going to upload that information to the record keeper. And when that information is uploaded to the record keeper, they get, the record keeper will deposit that contribution into the source that it should be deposited, and then track that money and gives quarterly statements. Matching contributions, if you have matching contributions for your plan, they can be calculated two different ways. First, and which is more typical for plan sponsors, is they're calculated on a payroll by payroll basis, and the match is generally calculated from the payroll company. So you would indicate what your match is to the payroll company, and they will make that calculation for you. And you can upload that information as well as the deferral information to the record keeper. The match is not considered a payroll deduction or entry, but some payroll companies will make note of what that payroll calculation is for each match, for the match as a payroll memo entry by participant. So you could see it on your payroll reports that way, but it's not taken into consideration with the payroll deductions and taxes. You could also have an annual match calculated. NOVA can calculate that annual match for you once we receive the census data in the early part of the following year. If you just want to make one deposit, we'll calculate that match for you and provide that to you in a spreadsheet that can be uploaded to the record keeper. The 5,500, Sue mentioned the 5,500 is due each year and needs to be electronically signed. Unless it's a special engagement, NOVA is going to prepare that 5,500 for you. So usually in the April timeframe, we're going to start working on that government return, and we'll send you an email with the link to say the 5,500 is available now to review, and you can electronically sign it. If it's your first year of signing the 5,500, there's going to be some signing credentials that are needed from the Department of Labor. It's a very easy, simple process that takes just a couple minutes, but that is gathered from the Department of Labor on their website. You'll enter a couple pieces of information, and they'll provide a user ID and PIN number. That user ID and PIN number will serve as your electronic signature when you file the 5,500. How does an employee get distribution paperwork upon termination of employment? We suggest that you give this out at their exit interview when they get their COBRA notices and all of those other notices that you're required to give participants. And that's for a couple of different reasons. The first is so that you know when you gave it to them. And so you can prove, if asked, to the Department of Labor when you give that notice to participants that they have money in the plan and that what their options are to receive it. But secondly, as Sue mentioned, there are forced out provisions in the plan for any account balances less than $5,000 that belong to terminated employees. Those amounts can be forced out of the plan if they don't respond within 30 days of receiving a notification. So if you give this notification to participants at their exit interview, you have the date in which you provided it, and you can force that participant out of the plan into an IRA after 30 days if they don't respond how to take their money. And that's an important process because you want to keep your plan clean. And the only way to keep it clean is to try and get as many of those balances out of the plan as possible. Those small account balances, if you don't push them out of the plan into an IRA, you'll be responsible for tracking them. They can become lost participants because they've moved or remarried, a different name. And then also you have to provide notifications to them as long as they have money in the plan. So again, just give them that notification that they have that they have money in the plan, give them their paperwork and their notification. And then after 30 days of that notification, you can force them from the plan. There are bunches of notices that are required for a plan. And some of the list of notices are here. The summary plan description, or the SPD, is going to be a more layman's term booklet that's provided to participants of what the plan document provisions are. So your plan document or adoption agreement is going to be your legal plan document that has your signatures on it as the trustee and as employer. But the SPD is going to be the same information in more of a question answer kind of format that's provided to the participants to let them know what the rules of the plan are. So that's required to be distributed to plan participants. And when I say plan participants, that means someone who's eligible for the plan. Doesn't necessarily mean that they have money in the plan that they're participating, but they're eligible for the plan. The next item, the summary annual report, or the SAR, this is the detailed listing of what was included in the 5500 that's been filed. And it's not participant specific, it is plan specific. So it's just a summary of that 5500 data. Special tax notice. Special tax notice is regarding the distribution. So it will let participants know if they take their money in cash, if they take their money and roll it to an IRA, all those different options, what the tax ramifications are to that distribution. And typically the distribution form with the record keeper will include that information as part of their distribution form, but sometimes it's a separate item. So sometimes you'll have two different items, the distribution form and the special tax notice, and sometimes you'll just have one form that includes both. The annual safe harbor notices, if your plan is a safe harbor, that is required to be distributed to participants each year. The annual 404A5 fee disclosure notices. This is an informational sheet that shows what the fees are being charged for the plan by fund or by distribution event. And then an annual automatic enrollment notice. And the annual automatic enrollment notice and the safe harbor notice is if your plan has those provisions. The others are for each plan. So 2 are only going to be if you have those provisions. The other 4 are going to be for all retirement plans. And who's responsible for distributing those? Typically, it's going to be you as the plan sponsor. We do have a sister company, ASS, that can assist in distribution of notices. But if you have a small plan, you might decide you just want to go ahead and give those to your participants. If you have a larger plan, you might want to contact ASS or your account manager to give you that information so that they can mail all those notices each year for you. So now we'll get into what is most important to a participant other than seeing their money get into the plan, and that is how do they get money out of the plan. And the first rule that we need to be aware of is that there needs to be a distributable event for money to leave the plan. A participant might say, well, the money's mine, I put the money in, I need it. Unfortunately, it was meant to be put in there for retirement, and there are limitations on how and why that can be withdrawn. And there's a couple provisions that can be put into the plan to make it easier, but some plan sponsors, they're adamant that that money's for retirement, and they want to be more stringent on why a plan participant can remove the money. But the first and most common, termination of employment. If a participant terminates employment, they're eligible for their distribution, and unless you have a specific timing of when they can get that money, typically it's going to be upon termination. So that's one reason, and the most commonly used reason why someone is taking money out of a plan. Second, age 59.5 distributions that we'll go over, hardship distributions, and then under the unfortunate circumstance of a death or disability. Again, with the termination of employment, withdrawal forms are just filled out for the participants that needs a distribution with their termination date, and they cannot remove that money until after that termination date has occurred. So they might want to start working on that paperwork, but until their termination date has occurred, that cannot be processed because they won't have a distributable event until that termination date. And then also we want to make sure that the final payroll contribution has been received. If the final contribution hasn't been deposited before the participant takes a distribution, that might trigger a second distribution, and a second distribution is going to trigger another distribution fee. So typically you'll want the final distribution, or rather the final contribution to be deposited and their termination date to have passed. And then again, employer, as the plan sponsor, needs to provide that special tax notice. Age 59.5, this is optional for the plans. You don't have to have this in your plan, but this is called an in-service distribution. And plan sponsors will put this into the plan so that participants can start getting ready for retirement. So at 59.5, that's a triggered date, because at 59.5, there's not a 10% penalty by the IRS for an early withdrawal. So that participant, once they've reached 59.5, if you have in-service withdrawals in the plan, they can take that money and move it to their financial advisor into an IRA outside the plan and start getting ready for retirement and diversifying their funds or whatever the purpose is. They don't have to roll it over, but that's typically what participants will do. Hardship distributions, again, this is a optional provision to put in the plan. You're not required to have it, but some plan sponsors want to have this in the plan in case a participant has a specific hardship reason that they need to access their 401k plan. This is not meant to be any reason under the sun, and we'll go over the reasons under the current law. And then because this is usually withdrawn after before 59.5, there will be an early 10% withdrawal fee that's assessed by the IRS. So again, this is just if participants have a hardship and need these funds available. And those specific reasons: purchase of a principal residence, prevent eviction from a home, unreimbursed medical expenses, post-secondary education, casualty losses, and burial expenses. And this would be for the participant and any of their dependents. So if they need access to the plan for any reason, they can take this money out if you have hardship withdrawal options. And unfortunately, we'll have to pay taxes and a penalty, but some participants feel better that if they have an unfortunate circumstance, they'll be able to pull money out of the plan when needed, and it will maybe entice them to save if they can have that option. There were some rules that were in place prior to 1/1/19 that have changed, and some rules have since changed, but currently, or previously I should say, you had to take a loan if they were available in the plan first before a hardship. That is no longer in regulation. So If you have a loan already, you can take a hardship. If you don't want a loan and you just want to take the hardship, you can do so as well. Previously, when you took a distribution for a hardship purpose, you needed to stop contributing to the plan for 6 months. That's no longer a regulation. I'm not really sure why that changed, because the ideology behind it before with having 6 months suspension was if you had to take a hardship and couldn't afford your circumstances previous, they didn't feel that it was affordable for you to continue deferrals into the plan. But that's no longer there anymore. So if a participant takes a hardship, they can continue their deferrals in the plan. Investment earnings on deferrals are now available for withdrawal. Previously, that was one of the only things that weren't available for withdrawal, that and safe harbor contributions. But now those earnings are available for withdrawal as well. Employer contributions could be available for hardship distribution. So if you're putting in a match or a profit sharing contribution, you can indicate in the document that even though you're allowing hardship withdrawals, you don't want the hardship to come from money you've put in. So that can be an option in the plan document. And also for safe harbor contributions, the same thing. It wasn't available previously. Now it can be an option in the plan document. So if that's something that you haven't put in your plan and you want to, just reach out to your account manager for that or the 59.5 distribution. In the unfortunate circumstance, if you have a death of one of your participants, those funds are distributed according to the beneficiary election. So hopefully that participant had an election on file, and that distribution form can be completed for that beneficiary. If they don't have a beneficiary on file and they were married, that spouse is going to be their beneficiary if there's not a beneficiary on file. So I guess to back up, if a person's married, they have to have spousal consent to name a beneficiary other than their spouse. And if they don't have a beneficiary on file at all, the spouse is automatically the beneficiary. The plan document it houses the order in which the distribution will be, I should say the funds will be distributed to participants if there's not a beneficiary election. The first, as I talked about, is going to be a spouse, then it's going to be kids, parents, and then the trust. So there is a hierarchy in the plan document. Age 72 distributions, these are required minimum distributions from when a participant turns age 72. And for any of you that have been in the retirement world previously, this was 70.5 until the beginning of this year. The beginning of this year, the required minimum distributions were waived for, I'm not realizing we're in a new year. For 2020, the provisions were changed. And for 2020, the RMDs were waived. And then after that, now they are age 72 rather than 70.5. So beginning in the year that an employee or a former employee turns 72, they need to start taking money out of the plan. Unless they're terminated, if you are an owner, it's the only reason that you'll be required to take that 72 distribution. So if you're active and not an owner, you don't have to take your money. If you're active and are an owner or a family member of owner, you have to start taking minimum distributions. And if you're age 72 and you've terminated employment, you need to take a required minimum distribution. And I know that is a mouthful with all those different reasonings. So the good news is that NOVA starts tracking that, and NOVA will reach out to you in September, October timeframe and ask you, these participants have turned 72, are they active, are they terminated, and we'll determine who is required to take an RMD. A quadro, Qualified Domestic Relations Order. This is usually an order that comes up in the context of a divorce. So if a divorce is occurring, there's going to be a domestic relations order in which the spouse is due money from the former spouse's account balance. These rules can be complicated. So if you received a domestic relations order in your office, please forward it to your account manager, who will have our distributions team review that domestic relations order, make sure that it has all the required information, and deem it as qualified. Once it's deemed qualified, then it can be acted upon. But again, there's a lot of specific things that need to be included in a domestic relations order. So just forward it over to your account manager and we will start the process for you. Spousal consent. Most plans do not require spousal consent. It's extremely important that if you do have a plan that requires spousal consent, that you do get that spousal consent. But for typical plans that do not have former money purchase plan money, that's a mouthful, former money purchase plan money, you will not be required to have spousal consent. Unless you have a plan that has that old money purchase money in it, spousal consent is not required. So your participant can take a distribution, they can take a loan, anything that they want to do with that retirement money, they are able to do so without spousal consent. Loans. Again, this is another option that's allowed in the plan but not required. But the same as I was talking about with hardships, participants are more enticed to put money into a plan if they know they can take it if needed. And that's really the gist behind the loans. Participants can take money out of their plan, and not only can they take it out, but they can repay it through payroll deduction. And as long as that loan is paid off in a time frame that's been amortized, there's no taxation of those distributions. So when we talked about the hardship withdrawal, that participant will withdraw the money and never pay it back. If that is the distribution that occurs, there's a 10% penalty if they're under age 59.5, and there's going to be taxes due on that distribution. As an alternative, they could take a loan for that same amount that they were going to withdraw. First of all, they won't have to provide, typically won't have to provide backup for why they're taking the loan. And they can take that loan and pay it back through payroll deduction and not have to pay taxes on it. So it's just available for participants who need money for an interim basis and can pay it back. There are some rules to what provisions you can have in the plan. The first is it can be no more than the lesser of 50% of their account balance or $50,000 reduced by the highest outstanding loan balance of any other loan within the last 12 months. So typically it's going to be 50% of their account balance, but if they have had a loan in the last 12 months, that $50,000 will be reduced. So it's the lesser of 50% or $50,000 reduced by their outstanding loan balance. So in this case, no loan is going to be more than $50,000 from a retirement plan. Just as there's a maximum, there is a minimum. The minimum loan amount is $1,000. So if a participant has $2,000 account balance, they can take a $1,000 loan. Again, it's based on the vested account balance. So if they're vested of $2,000, they can take $1,000. And the minimum is just put there really just to make it not thought upon as a savings account, that money is there for retirement plan purposes unless needed. And so if you had less than $1,000 loan, participants could be taking them left and right and paying them off, and it could become an administrative nightmare. But if you set the loans to say one loan available at a time, minimum loan $1,000, typically it doesn't get out of hand. The loans must bear a reasonable interest rate. That is prime plus 2%. Our legal team has deemed that to be reasonable. It's what a loan could be gotten for out in the market. And I don't think you're going to find a loan out there for less than 2% over prime. So again, that has an interest rate, and that interest goes back to the participant. The loan must be repaid within 5 years, and that's unless it's a residential mortgage loan. So if it's used to purchase a principal residence, that loan can be for up to 20 years, and there would need to be documentation that it's for principal residence, but otherwise any other loan for any other reason cannot be more than 5 years. Loans are generally paid through payroll deduction, and it's on a post-tax basis. So it's not a pre-tax deduction. So like your 401k deferrals are taken from you from your paycheck on a pre-tax basis, that is not the case with a loan repayment. So that's going to be a difference in the payroll setup. Also, loans generally become due upon termination of employment, and that's because the loan repayments come through payroll deduction. So if there's no more payroll, there's not going to be a loan repayment taken from those participants. You could have in your document that you allow payroll loan repayments outside of payroll deduction. I would not advise that because then you're responsible for trying to gather those loan repayments and depositing them on time. You want to just have them through payroll deduction when they're employed through your company. And then once they have terminated employment, they can choose two things. They can choose to repay it in full in one check outside of payroll deduction. So they can write a personal check for a one-time payoff amount, or they can let that loan default. And what that means is that those loan proceeds that still aren't paid. So say that they took a loan for $10,000 at the date of termination, they owed $5,000. That $5,000 outstanding loan balance becomes taxable. So they'll receive a 1099 for the $5,000. There are fees for the loan. There could be a loan initiation fee, and also the record keeper could be charging annual or monthly maintenance fees. But the participant bears the cost for the loan. There's nothing that a plan sponsor needs to pay for a loan or distribution fee. You could decide that you want to pay those fees, but I would say, I'm not even sure if I'll say 99%. I would say 100% of my plans have those fees paid by participant, not the plan sponsor. And of course, the participant always wants to know the fastest way to get a loan. The fastest way, if available, is to apply online at the record keeper. Once that loan is approved online, they can, well, I shouldn't say when it's approved, but when they apply online, they can request an ACH instead of a paper check. So once that loan is approved online, they'll receive an ACH debit instead of a paper check, and that will shorten the time period for all of that mailing time. So now we've gone through basics of a 401k plan. We're going to go through an annual calendar of what you can expect through the year. There are several items on here that are duplicated every month because it just depends on how often you let participants into the plan. So you'll see that I'm going to skip around on a couple of these and just give you the highlights of what isn't or could be every month. The first thing is the 1099. As I had talked about, if a participant receives a distribution or a defaulted loan, they're going to get a 1099 for that taxable wage or taxable distribution rather. That's going to be distributed by the record keeper no later than January 31st. So participants who takes a distribution in 2020 will receive that 1099 in January of 2021. In January, we send out our data request for 2020 work, and you've probably already seen those emails. I believe that all of the different emails have gone out, and that email will point you to our web portal so that you can enter the questionnaire information as well as upload your census data. So if you have any questions on how to do that, just reach out to your account manager. But now is when we start working on that. So as soon as your payroll is finalized for 2020, you can start submitting that census data. Moving on to February, NOVA is going to continue to work on compliance testing. So if we haven't gotten your data in January, hopefully we're getting it in February. and we're going to continue working on all of our plans for that testing. And January, February, and beginning of March is the busiest for NOVA, and that's because any plans that are not safe harbor, as Sue had mentioned, are subject to ADP and ACP testing for the deferrals and the match. And if that testing fails, the participants will need to receive refunds no later than March 15th. So it's a little bit of a crunch time for us trying to get your census data, get that testing completed so we can have any refunds processed by March 15th, because any refunds that are processed after March 15th incur a 10% penalty by the IRS. So we will be sending out reminder notices to you that we need your census data, and just know that we're just looking out for you guys to make sure that you don't have to pay that 10% penalty. In April is the first deadline for those age 72 distributions that we talked about. So for the first distribution the participant receives at age 72, it's due by April 15th. Any year after that year, it's due by December 31st. So April 15th is an important date for your age 72 distributions. The next important date in April is excess 402Gs need to be refunded. So this is when a participant has deferred over the $19,500 if they're age 50 or under age 50, and a $6,500 catch up for those over 50. So this typically occurs, it won't normally occur for someone who's employed by you for the full year, because usually your payroll system will catch this limit. Usually this is when a participant has moved from one company to your company, and between the two companies, they went over the limit. So since they're in your employment, they'll fill out a 402G refund form and request that refund sent back to them. It's not your responsibility unless it only occurred in your plan, because you're not going to know if they had a 402G excess if they had a prior employer and were employed by you guys. So typically, when people start doing their taxes, they'll start realizing they went over that limit and will contact you to find out how they get that refund sent back to them. In May, we're going to start working on those annual Form 5500s. So if we have your testing done, we can start working on those forms and get them ready for distribution to you so that you can review it and submit that timely. For large plans, if you have over 100 participants, if we finish your testing in the January through April timeframe, there's no reason that you couldn't go ahead and schedule that auditor to start working on your audit, so that as much information we can gather for them as possible so that we can meet the deadline for the 5500 due date. June, we're going to continue working on those 5500s and audit. July is the first due date of 5500. So a 5500 without extension is due by July 31st. So if you're a small plan, especially less than 100 participants, typically if we have your census data, we've completed your testing, we've completed your 5500, we will have provided you a draft 5500 to review 1 month prior to that due date. So if you have any questions, let us know, but we want to make sure you meet that due date. If for any reason you can't meet that due date, this is especially popular with the plans that are audited because the audit may not be completed. If that's the case, we can file an extension for your 5500, and that extended due date will be October 15th. Let's see. We'll move to September. September is the summary annual report needs to be distributed to participants. So this is that SAR we had talked about earlier that lists the information that's reported on the 5500. If you have not extended to October 15th, then you'll need to give that SAR to participants by September 30th. So you have a little bit, a 2-month leeway to get that sent to participants if you are not on extension. In September, we're going to start starting those annual mandatory cash out project. And what this is that we talked about earlier that participants that have less than $5,000 and have terminated employment, they can be forced out of the plan. We will start going through the plans and sending out notifications to participants that their 30-day clock has started. And if they don't respond, then we will complete the paperwork for you to force them to an IRA. October is the fully extended due date of the 5500. No 5500 should be filed after October 15th. If it is, unfortunately, there are circumstances that things have to be filed after October 15th, but you should know that there are large IRS and Department of Labor fees for having that late filing. So we will do everything possible to get that filed prior to October 15th. In October, we're also going to start the 72 RMDs, age 72 RMDs, and that's for any of those participants who have already received the first distribution and they're rounding their second year of being over 72 and getting that distribution by December 31st. And again, we're going to provide you with signature-ready forms to have those processed. November, the notices for these 3 items need to be provided to participants by December 1st each year. So in November, you should start gathering those notices. Contact us if you don't have a copy and have them to participants by December 1st. Very important to remember that due date. Let's see. December, if you had an extended 5500, that summary annual report is going to be due to your participants in December. And then, of course, December is a frequent deadline for IRS amendments. So we will let you know if there's any amendment that needs your execution so that you do not have a late amendment. And I think that is all on the calendar that I wanted to cover. But of course, if you read through this and you have any questions, just reach out to your account manager or me or Sue, and we can help you with those questions. I had talked about earlier that our sister company AFS can help with notice mailing. If that's something that you're interested in, you can contact Jake, and Jake can help you with how much that service would be for them to do that distribution of mailings. It's not required, but if you are distributing 100 mailings and having to take care of that yourself, that might be something you want to outsource to them. We have plenty of webinars that are starting to be scheduled for 2021, so just look out at our website and see what you might want to talk about. There's more specific, detailed webcasts on there. Then, of course, a reminder to complete your survey for CPA credit, and you'll get that CPA email within 1 week with the certificate. I'm going to leave this slide up for a second for contact information for me and Sue. If you've typed any information into the question box, we can get back to you once the webcast is over, since it looks like I don't know if we're right at the time or maybe we've gone over a little bit. But this is mine and Sue's contact information in case you have any other questions. But otherwise, I guess I'm going to pass it over to Jasmine, but I appreciate you guys taking your time to be with us today. And then also, sorry for the technical difficulties that we had at the beginning.
Thanks, Charlene. We did receive just one question from the audience. I believe this is in regards to the payroll integration. Does the payroll provider submit full census data each payday for small plans?
They can. So payroll integration is going to be on a provider by provider basis. So you'll want to reach out to your payroll company and see if that's a service they provide, but it does not have to be a large plan. It can be for small plans. It's just a matter of turning that option on if that's something you want to have them do. And then, of course, you can always reach out to your account manager, and we can be on the phone with the payroll company to kind of go through and guide you through the questions that you might have for your plan.
Thanks. So that looks like all the questions we received. Thank you, Charlene and Sue, for that presentation, and thank you to everybody for joining us today for an introduction to 401k plans. Please note there will be a survey that will pop up right after the webinar ends for you to complete if you are needing CPA credit, so please be on the lookout for that. The certificates will be sent out in 1 week, and a recording of this webinar will be made available on our NOVA YouTube channel by next week. If you have any questions, please reach out to your account manager and they will be happy to assist you. Or for any other questions, please email us at webinars@nova401k.com. Thanks, and everybody have a terrific Tuesday.